Hey everyone, one of the top inquiries I get from investors is about commercial real estate property distress. I guess every investor dreams of scoring the great deals of the 1990s RTC days, and a lot of capital is currently waiting on the sidelines for that distressed unicorn property to come to market with massive discounts. And yes, some of those types of deals have captured the headlines. For example, an iconic office tower in Portland, Oregon that traded in 2015 for $372 million recently sold for $45 million. That's the type of deal many investors are waiting for, although most would prefer it wasn't a 1980s vintage office tower in Portland, Oregon. So, are more distressed deals coming? If you look at the CMBS delinquency rates, there's a clear upward trend. Overall, the commercial real estate delinquency rate was 7.2% for July. That's up from 5.4% in July of last year and 4.4% in July of 2023. At its current level, the CMBS delinquency rate is above the long-term average of 5.5% and about on par with the readings at the beginning of 2014. CMBS delinquency hit its zenith following the global financial crisis, and in 2012 it was 10.3%. But if you look at the composition of delinquency back in 2012, it was broad-based. Apartment delinquency was 15.6%, hotels had 12.5% delinquency, industrial was at 11.7%, office was 10.7%, and retail had about 8% delinquency. In contrast, the current CMBS delinquency is much more heavily weighted towards office, which is about 11% delinquent, and retail is currently facing 6.9% delinquency, followed by 6.6% for hotels and 6.2% for apartments. The industrial CMBS delinquency rate is about 0.5%. So, while the percentage of properties that have missed at least one payment has increased, it's not as evenly distributed as it was following the financial crisis. On a property-by-property type basis, the delinquency rates for apartments, retail, and hotels today are generally less than half the levels of 2012. And remember, just because a property owner missed a single payment doesn't mean the property will go into foreclosure the next day. The debt market remains fluid, and many lenders continue to offer borrowers in good standing workout options. Yes, lender leniency has tightened from where it was a year or two ago, but investors have a range of borrowing options. Banks, insurance companies, CMBS, private lenders, debt funds, Fannie Mae, and Freddie Mac are all actively lending right now, with rates ranging from the low 5% range to about 8% depending on the asset and the borrower. So investors with debt coming due have options. Another source tracking commercial real estate distress is Real Capital Analytics. In total, the RCA Distress Tracker identified about $122 billion of commercial real estate facing distress at the end of the second quarter, and that's up by about $25 billion from a year ago. But in their report, RCA also highlighted that the total volume of distressed assets was down a bit from the first quarter this year. Office properties constituted the greatest share of the total distressed properties, with about 47% of the total. That was followed by the 18.8% share held by apartment properties. Retail was next with 15.5% of the total identified distressed properties, then hotels with 13.4%, and industrial with just 2.1%. But even though there has been a clear rise in the volume of properties facing distress, they only constituted about 2.6% of the total trade volume in the first half of 2025. And looking at the historical trend, that's about on par with the levels seen in 2016. Distressed sales are only nominally above normal, and they're far short, about a quarter of the levels experienced following the global financial crisis in 2011 and 2012. So there are some deals out there for investors targeting distressed assets, but they're generally fringe deals, often with significant deferred maintenance. Basically, the distressed deal flow is just a little more than what comes to market in a typical year. And while investors wait for distressed asset opportunities to emerge, their capital is often sitting idle. Given the currently elevated cap rates, investors may be better served by targeting high-quality performing assets that are currently on the market rather than waiting for the unicorn to show up. Now, there will undoubtedly be headwinds over the coming year, but the long-term drivers, including the slowing pace of commercial real estate construction and positive demographics, should ultimately play through. And that long-term momentum will likely be key for investors, especially those who keep their eyes on the horizon.